30 years ago, I didn't have a lot of money. I had a job, I paid my bills, my credit was pretty decent. But I was living at home. I hadn't really saved any money, and I was in a place where I really was not sure how I was going to build a stable financial future for myself. I was seeing other people that I knew that were buying homes and kind of getting their lives in order. And I was really kind of stuck at a place where I wasn't sure what that path forward looked like for me. Now, some things happened that changed all of that. The first thing was that I got married. Big step. Second thing happened almost at the same time, and that is that we decided to buy a house. Now, that was not easy for us to do. It wasn't, we struggled when we were younger, as I think a lot of young couples do, but it got easier over time, and that's kind of what I wanted to make one of the points in this video about is the big game changer for me as now a new homeowner was that over the course of time, we ended up building equity in that home. When I look back on that and realize that the equity that we built in that house over the years that we owned it ended up being really the foundation of the financial plan that we built for our family. And had we not bought that house early in our marriage, who knows how things work out, but we certainly wouldn't have had that nest egg that grew over time just in the equity that we had in the home. So why am I sharing this? Well, number one, I remember a time in my life when I kind of felt like someone on the outside looking in financially. I didn't really have a plan, and I was really not confident that I had the ability to put one together. I wanted to own a home, but I didn't know how to do that. And so I can sympathize now when I see that there's a generation of young Americans who have been basically told, home affordability is out of reach. You're never going to be able to afford to own a home. The American dream is for other people, and you're just going to have to get used to the idea that you're going to be a renter for the rest of your life. And if you are a member of that sort of group or that generation, I want to talk to you about that. Because, sure, I think that there's something to be said for the affordability problem. Houses are expensive. They're more expensive now than they've ever been, and it's getting worse. I think we can all admit that that's also true. But there's another side to that story that doesn't get really enough focus, and that is that, yes, housing is expensive, but renting is expensive too. So the clear difference between buying a home and renting is that when you buy, you own an asset, and it's an asset that tends to go up in value over the course of time. But another underappreciated aspect of owning your home is, especially if you buy with a fixed rate mortgage, your loan payment that you repay is a fixed dollar amount. It doesn't change over the course of time. Your taxes, insurance may go up, sure, but your actual loan payment is something that remains fixed, and it doesn't move over the course of time. Whereas if you rent, you lose both of those benefits. Not only do you not own anything, so any increase in value of the place where you are renting, it's going to your landlord, but also, you don't have any control over where your monthly payment goes, and there's no ceiling on that. So effectively, it could raise every year. It probably does. But over the course of time, you can see that could have a profound effect on how much you are paying on a monthly basis for your housing. And I'll give you sort of an example to illustrate this. If you imagine that you bought your home 10 years ago, 2016, and at the time you bought with a 30-year fixed rate mortgage, your rate's locked in, your monthly payment's locked in, and here you are 10 years later and you're still mailing in your monthly payment on that loan. Well, you were mailing in 2016 denominated payments on your 2026 house. Over the course of time, because the purchasing price of your dollars has weakened over time, we're going to get to that in a minute, but over the course of time, that payment that you are making that you started in 2016 is more affordable now than it was then. As 10 years has gone by, and if you look at the value of your home and how much that's increased, you can see proportionally what you're spending on your monthly payment has shrunk. Now, the flip side of that is that if you're a renter and you've rented the last 10 years, in 2026, you're paying a 2026 rent. Okay, if you look at next year, if you're the owner of the home in the illustration we just talked about, in 2027, you're going to still be making a 2016 payment on your home in 2027. If you're a renter, you're going to be making a 2027 rent payment on your home. That's just going to continue as time goes on. Your monthly mortgage payment has another feature that you don't get when you're a renter, and that is that your monthly payment is broken down in various components. In terms of the actual loan payment, we call it principal and interest. Okay, part of your payment goes to pay interest to the bank on the money that you borrowed. Part of it goes to pay the loan balance down of the money that you borrowed. And so that's your principal payment. And the key thing with that is that every dollar that you pay towards the principal of your loan becomes equity that you own in the home. So you're sending a monthly payment in every month on your mortgage. You're actually paying yourself with a part of that payment every single month. And that accumulates over time. It's something that happens a lot of times. For my first home, it happened without me really even paying attention to it. And when we got to a point where we wanted to go ahead and sell the home and our real estate agent came and gave us a valuation on the house, we were a little bit shocked at how much appreciation we had in the home. So that's the increase in the value, but also how much we had paid down over time in our monthly payments. Okay, so if you're paying rent, as you know, your monthly payment is gone the minute you make it, and any equity that results from that payment is going into the pocket of your landlord and not into yourself. But the biggest factor that I wanted to talk about in this video is something that we've alluded to already a couple of times, and that is inflation. All right, inflation. We all are familiar with the concept of inflation, and that is that over the course of time, the price of things goes up. Inflation isn't going away. It's a feature of the system, not a bug. They built it in to our economic system deliberately. And so if you look at our politicians, both parties have their fingerprints all over inflation. They have both spent insane amounts of money, rung up insane amounts of budget deficits. And our Federal Reserve as an entity, it's in my lifetime anyway, and I think you can argue going all the way back to the post-World War II, their favorite playbook that they pull out all the time, anytime there's a problem in the economy, is they just start printing money and they inflate the problem away. And it's gone on my entire lifetime, and maybe you think that's going to change, but I certainly don't see that happening anytime soon. We are facing continued problems economically, and the balance is how much can they get away with printing to not make inflation worse than it already has become in the last couple of years. So the effect on this is pretty plain to anybody that goes to the grocery store. Inflation means that the price of food goes up. It means the price of clothing goes up. It means that your gasoline prices go up, your energy costs, you name it, right? But the one thing that you also have to realize is that it's not just consumer goods that go up in price or in value. Assets also do the same thing in an inflationary environment. And so we're now talking about stocks, we're talking about precious metals, commodities, we're talking about houses and real estate. All right. So you may have heard the term inflation hedge. And usually when someone's talking about an inflation hedge, they're talking about what they also would call a hard asset. That's something that's sort of got a physical nature to it, that's tangible. And when you buy it, it becomes a store of value, so that if the dollar begins to lose purchasing power, then those assets that are denominated in dollars are going to go up in nominal value. So that's what you see over the course of time. I'm going to give you an example of this. Is if you can imagine, just pick a period of time that you could say that the dollar lost 50% of its purchasing power. And you would understand if that happened, that when you go to the grocery store, it would cost you twice as much to get the same amount of ground beef, for instance, right? So the flip side of that is also true, though. If you own a home and the dollar's lost 50% of its purchasing power, you would expect the value of your home to be double. And so the result of that is, when you're buying ground beef, you're getting poorer because it's gotten more expensive. When you own a home, you're getting wealthier because you have an asset that has gone up in value. Okay. So inflation is the double-edged sword in our society, in our economy, in our whole system. It is, you've heard the term, the rich get richer and the poor get poorer. And while there are other things that go into that equation, inflation is the biggest one. And it all comes down to rich people own assets, which when they go up in value, they get richer. And poor people buy stuff, which when they go up in price, they get poorer. Another way to look at it is that those who put inflation to work for them get wealthier, and those who don't put inflation to work for them end up just getting crushed by it. Okay, let's talk about your house now as an inflation hedge. Your house has got a feature that is not shared by any other inflation hedges, and that is that you can live in your house. You can't live in your stocks, you can't live in your precious metals, but you can live in your house. Since you're going to have a housing payment anyway, whether it is a rent payment or a mortgage payment, you might as well let your monthly payment go to work for you. Let your housing payment build wealth for you over time. All right, so just something that you should be aware of in terms of statistics, because this is really mind-blowing. But in the United States of America, the average homeowner has a net worth of $400,000. The average renter has a net worth of around $10,000. It's a staggering difference, and it is largely the result of the growth of equity that takes place over time through ownership of assets like a house. Now, there are intangibles to owning a home, and I get that. Some people aren't motivated by the financial argument, so we can give a nod to the other benefits of owning a home. A lot of it comes around to having control. You can paint the walls, you can get a dog, you can put up a fence. In terms of raising a family, you get to put roots down in a neighborhood. Your children, they get to go to school with their same classmates. They get the sense and pride of ownership that their bedroom is their bedroom, for instance. Your home is your home. And so there's a plantedness and rootedness that's hard to duplicate as a renter, and it's definitely a benefit of being a homeowner. Now, some people, experts, economists, will tell you that renting is a better option, that a home isn't a good investment, and that renting gives you a lot more flexibility. And for some people, that's very much a true story. I would never tell someone to buy a home when they're not ready to buy a home, or when their situation requires them to be maybe mobile and not rooted to one spot. But for the majority of the people who would like to buy a home and for whom it's a good decision, here's the only thing I would say in that regard, and that is just to look at the one single metric over every generation of Americans since World War II. The one single thing that is the best predictor of financial security and long-term wealth growth is homeownership. It's not a college degree, it's not how much you make, it's homeownership, and it's not even close. I believe we're at a crossroads. Housing affordability is a real problem, and it's getting worse. It's going to be worse next year than it is this year, and all the more reason that you really, you have to take a look at, are you asking the question, can I afford to buy a home? The real question you need to consider is, can I afford not to buy a home? Next year, it's not going to be any easier, nor the year after that. So the sooner that you can take control of your homeownership situation, the more quickly you can start to see the results of that in your finances. I want to help answer that question one family at a time. I want to help to be a part of the growth of a new ownership generation amongst the younger Americans who have been told that they've been locked out of the housing market, which I think is largely not true for millions of them who could benefit from becoming a homeowner. All right, check the link in the description below the video. You can drop your email in there, and I will forward to you a copy of my free book, which is called You Can Do This, the No BS Guide to Financing Your First Home. It goes over the process of buying a home from start to finish, and it is free of charge. Okay? Thanks for your time. This is Stan Brusoski, and I'll look forward to talking with you soon.